Good morning, everybody. Welcome to today's 1 Million by 1 Million Strategy Roundtable for Entrepreneurs. 1M, as you know, is the first and only global virtual incubator accelerator in the world with the mission of helping 1 million entrepreneurs reach $1 million and beyond in annual revenue, build $1 trillion in global GDP, and 10 million jobs. It's not a very ambitious goal, is it? 237th Roundtable. This is the 237th time that we are convening with entrepreneurs all over the world. And we actually started experimenting with this format way before the 1M program even started, or conceived. Actually, I was even conceived. So we've developed quite a bit of experience. 25,000 plus people have been participating in these programs. You will have a recording available after the session. If you're live tweeting the show, please use hashtag 1M1M. Our Twitter handles are at 1M by 1M, and mine is at Stromana. The recording will be at 1M Roundtables on YouTube and also on our blog. So you will have many different touch points through which to access the recording. These are the teleconference call-in instructions, which I will put them up later on in the program when we are ready for call-ins. This show today is a continuation of our launch event for the new Entrepreneur Journeys book, Carnival in the Cloud, which celebrates the journeys, entrepreneur journeys of 15 cloud entrepreneurs who have built fabulous businesses and attempts to learn from their experiences. And in celebration of that, we have a very special guest, Benhamou from Benhamou Global Ventures, a very good friend of mine for a long time, and actually somebody who has built a unicorn company. Some of you may have heard of 3Com. Some of you are perhaps too young to have heard of 3Com. We do get a very young audience these days as well. 3Com and Cisco went head-to-head when at the beginning of the networking industry. Now you take all this for granted, right? But there was a time when all this needed to be conceived and built and rolled out into the world's networking infrastructure, and Eric was one of the pioneers of that movement. So he was the CEO of 3Com. He was also the CEO of Palm, which 3Com acquired and then later spun off and took public, separately. Palm was the pioneer of the smartphone category. So again, now we take everything for granted. Apple iPhone dominates the market, but long before any of that happened, Palm was the leader of the category. So welcome, Eric. It's a real pleasure to have you here, and we are looking forward to learning from you, learning what you are seeing in the industry, what you're thinking, how you're analyzing, and how you're predicting and projecting the future of our industry. So let's start off with some general comments on where your head is right now.
Thank you, Stromana. It's great to be here. Thanks for inviting me. Well, right now I spent the bulk of my time running a second fund, Benhamou Global Ventures, and that fund has a very strong focus on cloud opportunities. The reason why we built Fund 2 is, in fact, because we saw the opportunities even beyond what we had originally assessed. We think this is really a very unusual time in enterprise IT. It's a once-a-generation type of opportunity where a new generation of companies has a space to expand and have an impact on the industry. The last time we saw opportunities of that magnitude was probably in the early 90s, when enterprises were moving away from mainframes and transitioning to PCs and to the internet. When that happened, incumbents got toppled, and a new generation of companies came on the scene. You mentioned 3Com and Cisco. They certainly had an opportunity as a result of that. But companies like Sun, Oracle, and many others had basically a white space to expand into. And we see the same sort of thing happening today, perhaps on an even greater scale, with the cloud-oriented companies. This is theme number one for us. We're looking for companies who exploit the new model, both at the infrastructure level and the application level. The second theme is cybersecurity, which is by far the fastest growing item on all IT budgets around the world. And the third is, I would call this ultra-mobility. I'm referring to the fact that today applications have to be written for the mobile platform first. And mobile refers to more than just smartphones and tablets. There's all kinds of mobile devices yet to be invented and rolled out. Just recently, we saw the preview of the Apple Watch to be introduced within a few weeks. I'm sure there'll be many other devices with yet different interfaces, but one common characteristic is that they're all mobile. And for us, this creates another set of opportunities. Existing applications have to be repurposed, and new applications have to be created. So these are the three basic growth vectors that our fund is attempting to exploit through startups.
So Eric, let's double-click down on the infrastructure side of cloud IT, enterprise IT, cloud IT. What is your, next level in thesis on that particular segment? What are you seeing? What is your analysis?
Well, the environment in which you develop applications for the cloud is very different from the environment in which you develop business applications a generation ago. The new environment is totally virtualized, and applications today use a modern set of tools and draw services from all kinds of other places, literally around the world. An application today is not a self-contained single thread of code, but rather it has dependencies on myriads of other services which get offered from other servers elsewhere. So the configuration complexity that exists today is totally unprecedented. And this calls for a new set of tools to basically keep track of this complexity and be able to improve the agility of IT organizations. For example, this whole concept of DevOps did not exist a generation ago, and it was introduced when people realized that there was this big moat between developers and operational people. And this was an impediment to the quick rollout of changes and new features and new applications. DevOps was an organizational creation to attempt to smooth the transition from development and creation to operational deployment. But that's not sufficient. Just having a DevOps organization, if you don't empower it with tools, is not going to really do much for IT agility. So a big theme for us is companies that can empower DevOps organizations to deliver on this notion of an agile software factory which continuously rolls out changes. So a few companies around the world have mastered the formula, mostly based upon homegrown tools. I'm referring to companies like Amazon, for example, which roll out changes to their websites every few minutes. But for most other companies, changes take weeks, if not months, to get rolled out, even simple ones. So we think this problem, which is not yet solved, is an opportunity for young companies to innovate. And that's one of our themes at the infrastructure level.
Super. So Eric, one other area along the lines of what you're talking about that we are seeing is, the notion of connectors, because there's so many modular technologies in use right now. Any enterprise is using so many different tools, so many cloud services, public cloud, private cloud, hybrid cloud, social media, et cetera, data sources. Connecting all these things together is a nightmare. So it seems like there's a whole connection layer opening up, which also needs an infrastructure level handling.
Yeah, we totally agree with that. So it's the same general kind of opportunity. It's basically dealing with the contemporary, totally distributed and totally virtualized data center, where dependencies are extraordinarily complex, and provisioning and orchestration is also very complex.
Yeah.
And so this is why you hear companies like Puppet and Chef and Ansible and Jenkins. These companies did not exist 10 years ago. Some of them not even 5 years ago. And this is to deal with a small environment.
Mm. Now, what is your analysis of the security situation? There are lots of security startups in the market right now, and that has been true for the entire time that I've been in the industry. You've been in the industry much longer, but I've already been in the industry for 20 years, so it's just a pretty long time. So there's always been a fairly strong crop of security startups, and some of them do very well. It's an active area of venture investment. What kinds of problems are we looking at currently as open opportunities or the new opportunities that people are going after?
Well, your comment is totally right regarding how fertile this cybersecurity industry is. There are a few things that we really like about the cybersecurity industry and a few things that make it a bit dangerous. What we like is that, in general, this is the closest segment to a meritocracy model. In other words, meritocracy referring to the better product has a better chance to win. Mm-hmm. If you're a chief security officer, you're not going to settle for second best or third best product. Even if you like the team, the company, even if you have relationships, really what matters ultimately is the product has to solve an important problem. Mm-hmm. And I couldn't say the same thing for many other sectors. So we like that a lot, and because it means that even a small company, if it really has a better approach, has a fair shot against a much richer, much bigger company. This we like. What we don't like is the fact that just about everybody in this industry is smart. I've never seen a cybersecurity startup that is created by stupid people. And they're all smart. The only difference is that some problems are absolutely essential, critical to address, and others are not quite as critical. So if you aim your gun at something that is not exactly the sweet spot of the market, you're unlikely to get traction and unlikely to get your company off the ground. So the challenge for us as investors is to separate these companies in terms of which problem are they addressing, and is this problem one of the top 3 problems that chief security officers are facing every day, or is it one of the top 20? If it's one of the top 20, let's not even try this. So let me give you an example of what I think is one of the top 3 threat vectors today that all CSOs are concerned about, and this is where we focus. Most malware today that infiltrates enterprises does the infiltration through the browser. So browser-borne malware, I think, is one of the top 3 threat vectors on enterprises. And that dates back to the fact that when we first invented browsers and the internet, we made the wrong assumptions. We assumed that the internet would be a very benign world. It has not turned out to be this way. Because we made the wrong assumptions, we did not create the browser as a very rugged, resilient, well-protected structure. Mm-hmm. So an HTML stream that comes into your browser and executes on your machine can do all kinds of nasty things which you cannot possibly detect. And this is how malware gets in. So there has to be a better approach than browsing like we all do every day. And because if we do this with the existing tools, malware just has too easy a time getting into your machine, getting your servers, and contaminating your application and your environments. So for us, this is an essential problem to address. Another problem, which I think you referred to in some of your blogs, is the fact that as applications get moved to the cloud, if the cloud is a public cloud or even a hybrid cloud, you have some exposure because your data is now in the hands of other people, protected by other tools that you don't control, and you have to figure out a way to protect your data at rest. So, this is another category of problems that comes with the cloud. The first category of problems talked about is not necessarily cloud related. Whether or not you're cloud-based, you have malware issues through the browser, but that's another one. I would say a third one, which I believe is going to be just as critical, is the fact that we're now moving very fast to a world of mobile commerce where many transactions are being carried out with card non-present. Apple Pay is starting to change the game because Apple Pay, in fact, treats these transactions as card present. But nevertheless, you still have other opportunities for cybercrime. But the point is that mobile commerce continues to have a very steep ascending trajectory, and transaction fraud is a big threat for all these mobile commerce companies. So we're very focused on that space. We think it's a challenging space because even if you have a really great solution to reduce the rate of fraud in mobile commerce, you have to affect the entire ecosystem for your tools to really have an impact. It's not enough to demonstrate it on a small sample. You have to have card issuers, banking players, payment processors, and so on. All of them have to buy into the system in order for the tool to be effective. Nevertheless, this is something which we think will be addressed by small startup companies as opposed to big players.
So I want to underscore one thing you said, Eric, for our audience about, in the CSO's priority in buying cybersecurity solutions, are you in the top 3 or are you in the top 20 makes a big difference. Are you in the top 3? That means that you'll have a decent, manageable sales cycle, and you will be able to scale a company at a pace that investors would desire. If you're in the top 20 but not in the top 3, that is not the case. The sales cycle is unpredictable, and it's likely to be very long, and that dynamic slows down growth rates, and investors tend to react negatively to that dynamic. So that's just FYI. Those who have been around the block know this phenomenon. Those who are doing it for the first time don't, so make a note of that. I'm going to switch topics a little bit, Eric, and ask you about, when we hear from VCs, and I talk to a lot of them, everybody's looking for unicorn companies. The truth, though, is that there are only a very few unicorn companies that have been built in history. Not even in the last 5 years or in the last 10 years in history, there have been very few unicorn companies that have been built. However, there's a tremendous amount of capital in our industry today, in the venture capital industry, and there's a tremendous amount of money chasing a very few opportunities that are going to become these unicorn-style successes. Now, you have told me in many of our offline discussions that your thesis is actually not to chase unicorn companies. Can you elaborate on that?
Sure. It's a point that I argue oftentimes with my colleagues in the industry. Don't mistake the intent. I'd love for us to find a unicorn company.
Yeah.
But the problem with unicorn companies is that, as you say, they're extremely scarce. And a lot of what makes a unicorn company is luck. and luck you really cannot control. And as an investor, I'm trying to strip out luck as much as I can from the decision that we make and the choices we make as investors. So let me start with the following observation. In any given year, in the U.S., you have about 10,000 new companies seeking early-stage financing. And in any given vintage year, only 5 or less of these companies will become unicorn companies. It's a very, very low yield. However, if you draw the curve of exit value compared to this universe of 10,000 companies, you'll find at least 100 who will have created values upon exit in excess of 100. In other words, while the curve is clearly exponential, if you go one notch below in the curve based on exit values, you'll find 100 companies. In other words, if you set your ambition slightly lower, you have a much bigger universe of companies to target. And if these companies who create more than $100 million of exit value, if you can spot them and invest in them at a time when they're worth only 5, and if you can ride the value creation curve from 5 to 100, you'll create very substantial returns, way in excess of industry average, in fact, in a top 5%. So the point is simply this. You don't need to find a unicorn company in order to create substantial returns for investors. You can find, as long as you have a good hit ratio of companies who take you from 5 to 100 or more, you'll do more than fine by anybody's standard. And to go from 5 to 100 is something which does not necessarily require luck. It requires primarily really excellent company, top-notch entrepreneurs who focus on really a good market. If you don't have, and in fact, it's probably in the reverse order. The market is the one factor you cannot afford to get wrong. The market has to be super strong with very, very strong growth vectors driving it. If you're able to get a good company with good entrepreneurs propelled by this vector, you'll ride that curve. Now, this is not automatic. This is not just like catching a wind on the surfboard. This requires a lot of skills and mostly persistence. But at least it's much more within your control and does not depend on luck.
So the follow-up question to that is, you said you argue with a lot of your industry colleagues on this topic. Now, if you think this way, and I am aware of the fact, and I'm picking up from your conversations as well, is that a lot of your industry colleagues are not thinking this way. So let's say you have identified some of these companies that can, and you have to manage how much capital is required to ride that curve. You have to do it somewhat capital efficiently. You can't raise $100 million and have a $100 million exit. That is not going to give you the returns that you're looking for. So you have to kind of manage it within a reasonable amount of capital. However, it's probably going to, let's say you do the Series A, maybe the company does require a Series B. Where does that Series B entrepreneur go who will think the way you are thinking?
Well, you raise an excellent point. We have to look at the entire life cycle of the company, all the way to self-sufficiency. And if we make a mistake of starting a company which requires $100 million of capital to fulfill its mission, we've made the wrong choice. So we focus on capital-efficient companies who may require $10 to $25 million of capital to accomplish or to execute the business plan. And if we contribute 10 to 20% of the total amount of capital, we'll have sufficient influence on that company. We'll have sufficient ownership of that company to make it worth our while. So we're not the right the right fund for all companies. Not every problem can be solved with $25 million of capital or less, but enough fall into this category for us to pick the strategy that we did. There are some companies, particularly in consumer-facing opportunities, which require massive amounts of capital to create mindshare, create a brand, or to create habits. And for this, I agree, there's no substitute for that. You have to have lots of capital, and you have to run very, very fast. At the other end of the spectrum, you have companies who have a substantial amount of IP lead, intellectual property lead. And those don't require massive capital to be able to get to a large market share.
Eric, just some echoing, Maureen. Who's streaming the echo? All right. So the last bit of that question that I was asking also is, who amongst your industry colleagues are thinking this way and going after these opportunities? Because you will not be able to put in the full $25 million or, whatever, $15, $25 million that the entrepreneur needs. There needs to be another group of investors who are thinking with the same kind of an investment thesis, right?
Yes, and we think there are plenty of them. So in this business, you cannot operate by yourself. You have to have lots of friends who trust you and who like to work with you. Unfortunately, we're in a good position because we've been in this industry for 3 decades, and we have lots of people who are anxious to get hold of our companies and to pick them up at Series B and beyond. So if you happen to be an investor that runs a $500 million to $1 billion fund, there's not that many opportunities available to deploy this capital. We supply a high-quality stream of opportunities at Series B and beyond, and we know who these people are. We work with them closely, and we don't wait until the company needs capital to tell them about what we do. In fact, as part of our mode of operation, before we make any investments, we try to envision the entire life cycle of the company. Try to see who else, well, first of all, who else would come in with us at ground level.
Yep.
But we'll also try to think about who might come at Series B 2 years downstream, or even at Series C. There has to be people who are, they basically have to be signaled in this way. This is a hot company that we want to introduce to you now, but 2 years from now, if they execute according to this, we'll want you to consider investments. We have this conversation all the time. This way, we can plan the entire life cycle of the company while it is in the dependency of venture investors. There's probably a dozen large funds today who have lots of capital to deploy, and we're close to these large funds. They typically cannot deploy this capital in the same sizes that we do. We focus on early stage and much more effective in mid to late stage, and that's just the way we divide and conquer.
So what I'm hearing, I think, to synthesize what you said is really to look for the more capital efficient opportunities that are less like playing in Las Vegas.
Yeah.
That are more execution dependent, that are more persistence dependent, not as dependent on the luck factor, and then riding that in a very disciplined, execution-oriented way to exit. And in the course of that is that entrepreneurs set comes up with a, maybe a second product line or a third product line that can take you to a unicorn level. That's fine, and then you will play the company accordingly. But at least in identifying your companies, you're creating an investment thesis that through 2 or 3 rounds of investments can get you a $100 million exit. That's kind of the synthesis of the thesis.
Yeah, that's exactly what our approach is. It's you know, in a SaaS business, for example, which is one of the new business models created as a result of cloud technologies. In a SaaS business, once you have a product that rolls out, and then once you've accomplished successful deployment across 1 or 2 dozen enterprise customers, you have a formula.
Yeah.
So that is completely up to you how fast you want to accelerate.
Right.
And you can make a smart trade-off between how much capital you want to deploy and how fast you want to go. So we want to get these companies to that stage where they have a product which is proven, a market that's clear to understand, and a couple dozen customers who validate the existence of this market. And once we have the existence proof of that these companies can perform up to that level, then a large fund can come in and decide whether they want to write a $5 million check or a $50 million check.
Mm-hmm.
And the risk is relatively controlled because the parameters have already been understood of what the business opportunity is.
Yeah. Yep, absolutely. So I know we're out of your time, Eric. I know you have to run, so thank you very much for sharing your insights. This was very interesting, and we will be publishing the recording, so we'll have a chance to have our more extended community listen to it. So we'll move to the mentoring session next.
Okay.
Thank you, Eric. Thanks again for coming.
Good to be here. Okay,
Bye.
bye-bye.
We are going to go to Shayuja Srinivas next, as Maureen tells me. Find your slides. All right, Shayuja. I don't know if
Hi, Shaman. Hello. Hello.
Your turn to present, Shayuja.
Yes, hi, Samana, and hi, everyone. Thank you for your time. So let me jump right into my presentation. Next slide, please, Samana. Hello. Yeah. So Dream Closet, we recently actually changed our name to Cycado. We are an e-commerce venture in luxury fashion with a rental model. So basically, the value proposition that we are promising to our customers is that they will never have to repeat something, and of course, it will be more economical and practical. Now, I've seen my mom do it, and I've done it, and I've seen my friends in hostels do it. We all sit in front of a closet that's completely filled, it's overflowing, and still wine that we have nothing new to wear. And, you know, there's always this desire to be seen in all the designer garments, and it's not really accessible to everyone. And even for those who have the resources to, you know, purchase those garments, it really doesn't make much economical sense, or, you know, practically doesn't make much sense to, you know, waste resources that you are not going to put into use effectively. So these are the problems that we're trying to address. Samana, next slide, please. So this is what I was talking about, the problem that we're trying to address. So for that, we've come up with a solution that is Cycado. And so we'll see our market segmentation. Next slide, please. So our market segmentation, we have categorized our market into you know, 4 parts. That first is the college-going girl who have the desire, but they lack the means to you know, reach those desires, get those desires, and at a later point of time, these are the women that are going to become customers to these designers. And it is, you know, studies show that 80% of the purchases made, it is based on 80% people purchase only when from the known brands. So we will basically act like trailers to the movies that designers are. And then coming to corporate women, so now with, you know, women empowerment becoming a reality, more and more women starting up, you know, they are getting to top positions, and they are getting very busy, and they have to keep traveling. So you just can't, you know, keep packing and stuff like that. So that is one other positioning that we can do. And next is the wedding market. Indian wedding market is a $1 billion market, and obviously it has a huge potential to be tapped. And fashion industry, anybody in fashion industry understands how dynamic trends and trends are, and to keep up with these trends, it will take a lot of money and time. So for that, we have a guilt-free shopping solution in which you can just take what you want and use it and return it back to us, and we will take care of the maintenance headache. And you just have to pay a very minimal percentage of the price you would have otherwise paid to purchase the product. And it is like a white elephant. You just buy something and you never put into use, and you have to spend on maintenance over and over. So we'll take care of that for you. So next slide, please, Ramna. So we have introduced these two models, rental and subscription models. We are ready to launch, and so subscription model is to get out of the cliched market where renting is only for big events like wedding or something. So here we, when it comes to India at least, for working women, there's not much choice for workwear that are trendy and also within budget. So this model basically is how it works is like you subscribe with us and we will deliver whatever you need for the week, and every week we'll be delivering it. For about the marketing strategy, we have come up. We're working on few. We're playing around with. Next slide, please, Ramna. So we are working on few models where we are trying to leverage the social media penetration, and we have other ideas like going directly to colleges and having brand ambassadors from colleges. So they will be marketing our product in their colleges and around their network. So something like that we've been working on. And coming to customer validation, it's been like a month since we started working on this project. So we're soon to launch a trial run with selected customers from each market segment to understand the value proposition and to understand what they want, when they want, and how much they're willing to pay. So based on that, we can design our inventory or tweak our model to increase the value proposition to our customers. So yeah, this is pretty much we have been till now. Next slide, please, Samna. That will be the last slide. So this is the customer validation part that we are trying to do. Yeah, and
your name? Can you pronounce your name for me?
I'm Sayujya.
Sayujya. Okay, Sayujya.
Yeah.
Have you looked at Rent the Runway? It's an American company.
Yeah.
Yeah?
Yes,
so you're
I have.
familiar with the fact that this concept is already amply validated in the American market. This company is already $100 million a year in revenue this year.
Yeah, that is right. But Indian market is very different from the American market.
I was coming to that. Indian market is very different. And the other thing is the Indian market doesn't operate in terms of, the retail side of the market. The fashion industry doesn't work the same way in India as it does in the U.S. or in So it's a very different market. It operates very differently. So you're going to have to take all of those nuances into account. You have to, you have to validate, and you have to be prepared for a lot slower growth. So I imagine that you're quite aware, based on your research, that this is essentially running a very, very, significant dry cleaning operation.
Yes, that is right.
Care of all of those logistical challenges and, the delivery service and network and all of that stuff. On that, if you can, I think you're on the right track in terms of you just need to really get it validated. And I would say you don't need to validate so many markets. Go for one market and validate one market at a larger scale than 20 customers in a consumer product or service doesn't mean anything. You need a really significant number.
Okay.
So
what would you say is significant number, Shamana?
The working women and get, several thousand working women to validate as opposed to 20.
Okay. That is going to be quite a bit of challenge, but sure, yeah, that makes sense.
It's not that big a deal, All these people are on Facebook or LinkedIn. You just kind of work with them, find 2,000 of them to work with you, and the chances are, if they actually are interested in using something like this, you would turn them into customers very quickly and just get the service launched, which is really what you want to get to. I actually think that the concept will work in India. You have to figure out the nuances and the details of how you're going to work. Like when Flipkart started doing e-commerce in India, one of their discoveries was Indian consumers don't like to pay with credit cards. They want cash on delivery. That was a nuance of the Indian, that was different from the American market. So that's fine. You will, as you start working and validating with your customer base, you will learn what those nuances are, but work with one customer base, because a college student customer base will behave very differently from a working women. And that working women customer base will behave very differently from a socialized woman customer base. And the inventory and the type of merchandise you will have to carry will be very different. So don't go after all of them. Go after one of those segments, pick whichever one you feel more confident about, and then go after that one.
Sure, Shamna. Thank you so much. It was great talking to you.
You're very welcome. Okay, we're going to go to Ramakant Desai. Ramakant, you can unmute your line and tell us what CareNet is. Are you on the call?
Yeah, I'm on your phone line.
All right, go ahead.
Can you hear me?
Yes, we can hear you. Go ahead, Rama.
Oh, okay. Maureen, can we go to the next slide? This is brief summary of the solution which we are planning. Telemedicine, as you know, represents a paradigm shift in the approach to patient care with technology advances and also proliferation of internet. Okay, now allow patient diagnostics to be run from a remote location. Okay, location agnostic patient care allows for more effective load balancing, especially across specialist doctors. Okay, current Indian ecosystem is right for establishing telemedicine. Basically because there is a huge unmet demand from the semi-urban areas. Okay, all of them want access to quality healthcare, but at the same time, the quality healthcare is only present in the urban areas. So that's one. That could be the prime driver for telemedicine in India, and also obviously because there is a huge growth of internet spread in India through various service providers and stuff like that. Okay, so we are developing this solution CareNet, which offers a compelling telemedicine solution. It's an integrated platform comprising of a couple of medical devices, cloud application for specialist doctors to use, and also a couple of other digital essentials which are required in the telemedicine at the patient side. Okay, it is our solution.
Ramakant, just a second. You are offering a platform for running a telemedicine offering, but not a telemedicine center. This is a technology and device platform.
Yeah, what we have developed is first initially we started with service, then we started assembling the solution together. Okay, so the entire solution is not owned by us. There are a couple of third-party pieces, but what we are planning to deliver it is as a service. Okay, the application is essentially from the cloud application is from Tatva. Okay.
So the cloud application is really your intellectual property. The medical devices and all that are required, you're basically reselling or configuring those, but those are not your intellectual property.
No, there are two pieces of the intellectual property. One is if we go to the next slide, I can explain in the next couple of slides. Okay, there are two pieces. One is at the patient console side, you need a data hub which can integrate with various medical devices. Okay. And then you need to do the backhauling of data through a cloud application to the specialist doctor who is remote. Okay, so that data hub and the backhauling of the data, which is required for the specialist doctor, is the intellectual property which you are bringing to the table. Okay. Okay. Obviously, the medical devices, are the standard medical devices, but the cost-effective ones which can be used in a semi-urban area.
Okay.
Okay, and essentially it facilitates that the remote telemedicine teleclinic can be run by a trained paramedical person or a physician, okay? In extremely remote areas, we do not get doctors, physicians. You have to run it with a paramedical person. Whereas in tier 2 towns, you get doctors, okay, whom you can employ, and then or establish a physician with whom you can establish a franchising model, okay?
So what is your assumption regarding the configuration? Are you assuming that you're going to be powering the rural remote centers, or are you going to be powering the urban delivery centers?
We are initially starting with the tier 2, tier 3 towns, okay? We'll go to the rural area at a later point of time, okay? Phase 1 is mostly focused on tier 2 towns. We are going to establish this solution. We are going to speak to establishing physicians who already have a captive population, but their patients do not have access to specialist doctors. Okay, so we are going to provide a panel of specialist doctors from a city like Bangalore, Hyderabad, or Ahmedabad.
Let's say you are going to a bunch of tier 2 cities that are, whatever distance from Bangalore. You still need to work with Bangalore physicians who are going to be delivering the remote specialty service, right?
Yeah, Bangalore specialists, yes. Answer is yes. So
are they operating out of a particular infrastructure in Bangalore that you are supplying as well?
No, the doctors, the specialists will be on their own. We are just going to provide a laptop device and one tab. Nothing more than that they require. Okay, they don't require anything more than that.
Okay.
Okay, so but they will be connected to the cloud application, and so at the teleclinic you will have the ECG, the digital step, the ENT scope, the video devices, and all which are connected to a data hub, and then there is a cloud application which will have multiple doctor interfaces, integration with hospital backend if required, okay, and stuff like that, and the telemedicine cloud application.
Yes.
So essentially the SaaS and the data connectivity hub is the intellectual property.
Yes, good, excellent. All right.
Okay, and I have an experienced team of professionals, okay, who can with proven track record as the kind of guys who can operate this setup, okay, for the time being, and gradually I'll start empaneling more and more of specialists, and also more and more of established physicians in tier 2 towns into the whole network.
So now my next question is, who is the customer?
Okay, the customer is
hang on one second, Ramakant. If you have this platform that kind of sets up the rural telemedicine center, are you running those centers yourselves, and then the customers are the consumers? Or are you selling this platform and maybe even the operational services to local medical companies who are then delivering the services to the consumers? In other words, it's B2B business or a B2C business?
Okay, it's a B2B2C business, okay? I'm going to the local doctors who are established physicians. I'm going to set up my solution with them, okay? And the patients who come to them who need a specialist opinion from a city specialist, okay, they will be the kind of access model for me. The local established tier 2 hospital.
Who's paying you? The question is who's paying you?
The patient will pay.
So it is a B2C business. The physicians, the rural business are your distribution channel, but it is a B2C business.
Exactly. You are right. You are right.
Got it. All right.
And typically the cost of establishing this, okay, is approximately, including the operational cost, okay, for one teleclinic, it comes to around about 11 lakhs of rupees. Okay, I should have put it in dollars, I'm sorry. Approximately per consultation, if I assume I can manage 30 consultations per teleclinic, it comes to around about $2 per consultation, it is far less compared to the cost of the travel, which a patient will have to do, a city, stay cost, all of these things combined together, this will be far less. Okay? And I've spoken to, sorry, go on.
So I am interested actually not in 25 clinics across 8-9 towns. I'm interested in the numbers that are involved in setting up one clinic. What does it cost to set up one clinic, and what is the break-even point for that one clinic to prove this whole model out?
That's what I have written. Here, it costs 11 lakh rupees, okay, approximately 1 million rupees to set up one teleclinic.
Okay.
Okay. And assuming that I get 35 consultations through one teleclinic, each consultation cost comes to me approximately to $2 in terms of running that as a service.
Lakhs of rupees, tell me the whole picture in rupees. Don't give me one number in lakh, another number in dollars. That's not very helpful to make any calculations. Then I want to know what is the break-even point. With 11 lakhs of rupees of investment to set up one center, how long does it take you to break even?
It takes me 8 quarters.
It's a 2 years to break even point.
Yeah, that's when I start turning profitable. Yes, you are right.
Have you started this already? Is there any center running yet?
Yeah, we have already started with a couple of remote locations, which are around about 150. Are not broken even, but I'm sorry, the previous sheet had the exact details. Okay, we have started.
Presentation like this is unreadable. It does not belong in this kind of a presentation. So you have 2 centers up and running right now. Is that accurate?
Exactly, you are right.
Okay. So you have set up 2 centers and they're running and they're producing revenue. The numbers that you're quoting, that they're going to be so many patients a day and paying so much, all those are validating? They're all turning out to be actual numbers?
Yeah, we already have approximately 15 to 18 consultations per day per clinic. Okay, but we are very confident that each of those will run up to 35 consultations per day.
Okay. So based on those 2 centers right now, at what point are they going to get to the numbers that you are quoting here of your assumption of 35 consultations per day at the price point that you are quoting?
In another probably 3 to 5 months. I'll tell you there are 3 types of services which we are offering. One is there are a lot of secondary opinions which customers want. Number one, secondary opinions. There are a lot of revisits. Once a patient comes to a city, okay, when he wants to revisit the doctor, he is open to using a local teleclinic. This, a couple of specialists have referred their patients to that teleclinic. Hey, let me use this facility. I don't want to charge unnecessarily my patients to come down. Okay, so this is the second one. Third is the actual inflow into the teleclinic which happens. Okay, so these are the 3 forms of services which are seen.
Okay. So do you have the financials the financial resources to run this all the way through to prove out your full model right now?
No, we do not. Okay, we are seeking funding. Okay, we will need at least to set up the 25 teleclinics. Okay, and also run them, and also need to enhance.
You don't need to set up 25 daily clinics. You need to run 2 clinics that you've already set up and prove out the model fully. You don't need to set up 25 daily clinics right now.
Yeah, I need funding. Yes. The simple answer is yes.
Yeah, and I think that the trouble is that it's kind of like in that twilight zone where it's not quite ready to be funded. It needs work, and you're going to have to kind of keep going until you can get it to a stage where it's ready for funding. It is this, as it stands right now, it's not ready for funding.
Yeah, fair enough.
So, what I suggest is you hang on and I will explain to you how we work and how this funding and details of how we work on fundings and so forth. But there's a lot of work that needs to be done here to prepare it for funding still. And in the meantime, you have to figure out how you're going to sustain the business, until you can qualify for funding. Okay?
Yeah.
All right. So let's actually go to the segment where we are going to talk about 1M1M, and then we'll come back to Q&A in a moment. So if you like what we're doing here, by the way, we request you to refer 1M1M to serious entrepreneurs. And the term serious is really important for us because we are looking for entrepreneurs who are going to be persistent and execute on whatever it is that they've set out to execute on to build significant businesses, and that is a multi-year journey. This is not something that you try for 6 months, and if it doesn't work, you move on, you quit. That is not the kind of entrepreneurs we are interested in working with. So I'll run you through the way 1M1M works for those of you who are interested in working with the program. Everything is at 1mby1m.com, right, by the way. We have a blog series that is completely free and is chock full of learning materials. Great learning materials. We also have the Entrepreneur Journeys book series, of which we have published 10 books so far. Next week, we're going to publish the 11th book. We're going to launch the 11th book. Each of these use the same format of case studies and analysis synthesis of different entrepreneurs who have been successful and illustrating the lessons from the trenches and the learnings and advice from those case studies and those entrepreneurs. So today we've had over 600 significant successful entrepreneurs participate in this case study program, and these books are synthesis of some of those topics that we have dealt with, and the entire 1M1M curriculum is drawn from the experiences and the learnings of these significant entrepreneurs, successful entrepreneurs. This is what the site looks like. There are lots of videos that explain the program. Every Thursday we have these roundtables. We've had this is our 237th roundtable, so 25,000 plus people have attended these sessions. It's been around for a while. If you want to pitch or attend, you can just go to the Free Public Roundtables page on our website, and you can register. The full calendar and registration links are all over there. Then we have a premium program, which is a $1,000 annual membership fee for unlimited access to a variety of different services. We offer you extensive methodology guidance of exactly how to put one foot before the other. We provide you with a curriculum that is very rich, very strong, and as I said, it's based on our experience of working with over 600 successful entrepreneurs who have very generously shared their stories, their lessons from the trenches, their methodologies, their strategies of making a business come together and succeed at scale. We help you with business development, lots of introductions to potential customers, channel partners, wherever we can, connect the dots, so to speak. We have similar sessions that are our private roundtables for members only, where we do the strategy consulting. That is the interactive, whether it's consulting, mentoring, coaching, whatever you call it. That's where we have similar sessions like these for members. We help you with financing. Now, financing is a complex topic. You need to understand what gets funded, and we provide you with a full diagnostic of that. We also provide you the full training on what a financeable scenario is, and that eventually the work product that comes out of that process of working with us on your financing endeavor is a slide deck. We give you a full template and everything. We help you through multiple iterations. We help you develop that slide deck, as well as other related collaterals that are required to start a financing roadshow. And then when you are ready, we will introduce you to investors who are likely to look at your particular opportunity and be interested in investing. So this is very much part of what we do, and just with the caveat that not every business is financeable. This is where the diagnostic kicks in. You have to understand that some businesses are fundable, some businesses are not necessarily fundable, and that's just the calculation that you have to make based on the parameters of your business, and we teach you the full, details of all of that. And then the last piece that we offer is working with the media. We have a lot of relationships. We introduce you to potential media opportunities. We bring you into potential media opportunities. We cover you ourselves. We give you access to our full social media presence through which you can propagate your messages. Our social media presence is very significant at this point. If you go to the website and look at the $1 Million Club, you will meet some of the entrepreneurs who are in the program and who have been successful. We provide you with an ROI equation of the 1M1M program, which amounts to $375,000 plus 5 to 10% equity worth of value for just a $1,000 annual membership fee. And we provide you orientation material on how to use 1M1M effectively. The self-assessment is something we recommend that you take a look at and kind of take your project through. These are the kinds of questions investors would ask. These are the kinds of questions you should ask yourselves in formulating your strategy. The premium program, there's tons of information. If you're trying to evaluate the program, there's lots of information, videos, video FAQs, etc. on the website. And we don't do a lot of selling. We kind of assume that you are incredibly smart entrepreneurs and you should be able to self-evaluate. So what we do is we provide you with lots of material using which you can self-evaluate whether this is the program for you or not. We are not for everybody. We are a program that requires that you're going to do a lot of self-learning. We're like a gym. You subscribe to a gym membership, but just by subscribing, you don't get in shape. You have to use the machines and do the work. That's exactly the philosophy of the 1M1M program. We are an entrepreneur gym. We give you lots of resources and a lot of coaching and hand-holding and introductions and network and all of these things. But you have to pull your weight. You have to do your part to be successful in the program. So I strongly recommend that if you are not comfortable with doing that level of work, do not join the program. We will not be able to help you. The curriculum is structured as core and elective, and we have case studies of several hundred successful entrepreneurs and synthesis of those, the lessons and the learnings in form of video lectures. The core curriculum has 7 topics: bootstrapping, positioning, market sizing, customer validation, financing, customer acquisition, and team building. And then the electives span from Web 3.0 and e-commerce, cloud computing and business solutions, outsourcing and consulting, mobile and social apps, healthcare IT, online education, gaming, etc. Our methodology is lean, capital-efficient bootstrap startups, and the reason being that today investors are looking for fleshed-out businesses to invest in. They're not looking for nebulous concepts. So to go from a nebulous concept to a fleshed-out business is probably anywhere between a 6-month, 12-month, 18-month, sometimes 36-month journey. And that is a period that you have to bootstrap. The best you can do is probably friends and family financing. But to get professional investors to invest, you have to get to a fleshed-out business. This is why we use the lean capital efficient bootstrap startup methodology very heavily and very effectively. This is a page on the accessible from our press navigation button. This is an example of coverage of our premium members. And these are the Twitter, Facebook, LinkedIn channel access that we provide through 1M1M. You can access our full range of social media channels, blog included, to propagate your message. And you do need to access these channels to really fully make use of the resources that we bring to the table. It's very important that you get out there. People get to know about you. You don't want to be the best kept secret, You you're so paranoid about your intellectual property and your confidentiality and people will steal your ideas that you become the best kept secret in the industry, and in the meantime somebody else who's less paranoid goes out and makes their product visible and known and becomes successful. That is not a desirable scenario. All right, so if you're an organization anywhere in the world that is in a related business of supporting entrepreneurs, you're very welcome to become an affiliate partner of the 1M1M program. We pay 10% affiliate commission of the premium membership fee. Our upcoming free roundtables are, there are 2 more in November before Thanksgiving, and then 3 in December before Christmas. So we have 5 more roundtables available this year. So please book your slot and let Maureen know. Work with Maureen. She will give you actually very clear instructions on how to pitch. We give you templates on how to pitch, how to create your presentations and so forth. The more you use our resources, the better you will do, and however, you do need to use the resources. Vision India 2020 is a book actually that I wrote we published it back in 2010, and in fact it has a telemedicine project. So if you haven't seen that, you should take a look at it. The person who's doing the telemedicine venture, it's kind of fleshed out actually. 1M1M Incubator in a Box is our platform that a lot of other partners are using to bring their own incubation services into the market, and this can be used as a as a complete solution or as a supplemental solution to existing resources. Either way is fine with us. Again, Carnival in the Cloud of the Entrepreneur Journey series is the book that we are celebrating the launch of today, and it's available on Amazon Kindle. Also, last month we launched From E-commerce to Web 3.0, how to leverage the evolution of the internet, and in fact it has a very good coverage of the topic of online fashion. So it seems like there are a lot of entrepreneurs who are working on online fashion right now who would find that useful. That's pretty much it. So we're ready for Q&A. If you would like to call in, these are your instructions. You could also ask questions or introduce yourselves in public chat if you like. Please set your chat to send to all participants, and we'll pick up the questions there and answer them as we go along. So now it's open Q&A time. And Clark says, Romana, just wanted to let you know that Irina answered many of my questions yesterday. We had a really productive conversation. Thanks for putting us in touch. Excellent. Glad to hear. Are any of you planning to call in, folks? Yes? No? Any questions? Comments? You know, you must ask questions. That's how we get to know you. That's how we get to, you should also introduce yourself. Tell us where you're joining from, what are you working on, what brings you here, what are you, what are issues that you're struggling with. That's why we are here. And while you're thinking about that, let me introduce you to Irina Patterson, who will be happy to answer any of your questions on a one-on-one basis. You can call her, 786-301-2456. You can Skype with her. Her ID is Irina_Patterson, and you can email her at irina@1mby1m.com. So she will be more than happy to answer any of your questions about the program itself. Anybody? Questions, comments?
I have a comment, Romana. This is Irina.
Please go ahead.
I will be very happy to answer everybody's questions, providing that before you call me, you go through the frequently asked questions.
That's a very good point. We have a very, very well-developed FAQ section as well as a video FAQ section. So it would be great if you can take a look at that. Nobody has any questions, looks like. And if that is the case, then we will wrap up. Thank you very much for coming, and we will look forward to seeing you next week. Bye, everybody.